Hey, thanks a lot for joining us. We'll go ahead and get started. I know it's right at 1, so I'm sure there'll be people rolling in. But we'll go ahead and get started. And the reason for this webinar is just obviously there's been a lot of volatility in the markets overall. Certainly that's bled over into the energy space and into the midstream space. And given that, and given that a lot of our models were run in January at a much higher price curve, our analysts went ahead and we ran a lower price scenario to see what kind of impact that could have on the midstream companies. So we'll go into that, and this slide deck is based off of a piece that we released on Monday, just a snapshot piece that is certainly available for anyone who's interested. Reach out to East Daley, and you can get a copy of that. So this is Matt Lewis. I'm Senior Director here at East Daley. I'm joined by Ryan Smith, also a Senior Director here. And we'll go through some of these slides. We'll pass it back and forth between one another so you guys don't get too bored with one person talking. But we'll start with Ryan. He'll do an introduction to us, and then we'll kind of go back and forth through some of these slides and hitting on the impacts that we see because of the lower prices to some of the midstream companies that we cover. So obviously some are more protected than others in a down price environment. So we'll go over that, our assumptions behind that, and we'll start there.
Cool. Thanks, Matt. A couple house cleaning items that I did want to bring up. This is Ryan Smith this time. We are recording this webinar, so this will be available after the call. If you want to tune back in and listen or share with others, we'll make this available on our website. As Matt mentioned, there is an accompanying snapshot report that we published earlier this week that goes along with the slide deck. And then tomorrow morning, we're actually releasing a second edition of this report that is more commodity focused. So a couple of these slides will have some of those commodity conclusions that we're featuring in our report tomorrow. So I would urge you to read both of those reports as well as listening to the webinar today. So introduction to East Daley. East Daley is the only data and information company that bridges the gap between commodity research and capital markets in the midstream sector. We like to play between those two markets, which flushes out some unique conclusions. So with all the price volatility that we've seen recently, again, we wanted to address these. We wanted to address the updated prices that we're seeing in the market today and run that through our models. So what we're really good at is taking these macro conclusions of updated price assumptions and then running them through our comprehensive process to flush out conclusions and trends that we're seeing at an asset level in the midstream sector. So these are things, this is an opportunity that, to be honest, we're kind of in the weeds all the time. We enjoy flushing out these types of conclusions. So with that, I'll hand it back over to Matt, and we'll walk you through some of the analysis that we've done recently.
Thanks, Ryan. So remember, as we go through this deck, is we're comparing our January models, which were released in mid-January, but that was based on a early January price curve. So we're comparing in this analysis that early January price curve, which was quite a bit higher. And if you look at the slide here, I have the graphs for Henry Hub and WTI. That's that black line. So hard to imagine that in early January we were actually at over $60 for WTI, but we were. So comparing that in our models to the downside case. And the downside case is that red line for WTI and Henry Hub. And we've made similar adjustments to the NGL price as well. So the assumptions behind the downside case, and I should say here, I have Friday's forward curve in here as the blue line. So I think we're probably pretty close to that today still. But the assumptions for the downside case are, what we basically did was we took 2Q 2020 to 4Q 2020. We took that forward curve on Friday and basically chopped those prices 20% across the board. So that's for WTI, that's for Henry Hub, that's for NGLs. And then in 2021, we chopped the prices 10% off the Friday forward curve. So it's a 10% decline from that blue line that you see there. And then in 2022, you get a 5% decline off that blue line. So essentially what it is it's a massive shock, and really it's an extreme downside case scenario of, in my opinion, what would happen in a potential worldwide recession because of the virus fears that we've seen. So that's the downside case, and I'll remind you again, this is the analysis that we're doing here is comparing that black line, which is the curve that we set in early January for our models, to the red line. So there's quite a bit of gap there, and this would not be our base case today. These numbers that we're going through, it is the downside case. So I'll kick it over to Ryan, who heads up and runs our production team. So he'll go through kind of our analysis and our assumptions behind U.S. macro production in that type of a low case environment, as well as basin by basin. He'll hit on some of that as well.
Yep. So taking that macro price conclusion of the red dotted line, if we run that through our production scenario tools, which are they're production forecasting models that are done by basin, and we forecast rigs as a function of price. So we correlate rig counts in the future to how rig movements to price have correlated historically, and we assume that relationship holds going forward. So if we run that red dotted line that, it starts at like $35 a barrel in the near term, we run that through our models, you can see that we significantly take a bite into our U.S. oil production forecast in 2021 and 2022. So the way I've heard production explained to me in the past is it's like an aircraft carrier. It takes a long time to turn it around. So there is a delayed reaction here. We're into March in 2020. So producers, if we actually get down to that very negative price scenario of under $40 a barrel for 2020, it's going to take a little while for those producers to really trim back drilling activity. So most of the impact felt is actually in 2021. So we do see a reduction in 2020 output. But the real impact, when you start to get up to like the 12% cuts, is out in 2020 and 2021. So you can see there that some of the basins that are the most impacted are ones that historically the rig counts have fluctuated more so with price impact. So the Eagle Ford, the Anadarko Basin, and that table down to the right is actually a summary of our rig reductions by basin. So the Anadarko Basin, in spite of already losing over 90 rigs year on year, we do expect under that downside scenario, you would lose an additional 37 rigs, which is the highest percentage impact, as they tend to be more sensitive to changes in oil prices relative to like the Permian Basin. Permian Basin is highly economic. You have a lot of operators that are strategically dedicated to the Permian Basin, so you see less of a percentage impact, although we lop off 145 rigs off of our forecast by the end of the year in the Permian Basin. So to boil it down, this forecast assumes about a third of the rig fleet is laid down by the end of the year, which does take it causes our U.S. crude supply forecast to move lower, especially in 2021 and 2022, which does have some significant impacts on certain basins and asset types. And that's where I'm going to hand it back over to Matt, that he can walk you through some of the implications of what that means by basin and by asset.
Yeah, and it looks like at a macro level, Ryan, correct me if I'm wrong, it looks like about a 1.3 million barrel a day reduction in production peak to trough is what we have there. And as you can see in the little table below the graph there's the percentage declines in production. Certainly the DJ, the Anadarko, and the Eagle Ford are forecasted to be the hardest hit in a scenario like that.
And that's a good point, Matt, because if you look back at the last time we had a price crash in late 2014, the peak to trough decline was about 600,000 barrels a day in that previous cycle. So this was a little bit more severe because you had such a run up in Permian production that you're faced with those really steep declines of a run up in that Permian growth wedge there in the green. So just kind of looking back at the previous cycles when we've seen price reductions, this one appears that it could be a little bit more severe if you get down to that sub $40 barrel level.
And maybe a little bit obvious, but we would point out that like Gulf of Mexico, those are kind of projects that once they're online. So certainly would probably impact the growth going forward for that and new projects getting sanctioned. But that's one area where, listen, if a midstream company has some Gulf of Mexico assets, we probably aren't changing those that much in a downside scenario. So it's one area that's somewhat protected over the downside. So going to the next slide, let's boil this down into, okay, how does East Daley feed this forecast through their models? So Ryan showed on the previous slide, here's our U.S. macro production, and what's showed on that slide is the basin level production stacked on top of each other. So we're looking at basin level production, and in this case, I'll kind of walk through how we look at the Bakken under a downside case scenario and how that lower oil production forecast feeds through our asset level analysis. So these tables are meant to show this, and this is from our new Bakken production and constraint forecast report that we put out on a monthly basis. So these tables are meant to show very simply and very intuitively how we balance crude oil production out of the basin. So what you have on the top chart there is the supply piece of the equation under the base scenario. So that's made up of really any supply that gets to the Bakken. So that's going to be a combination of, in the Bakken, it's pretty easy. It's just production. And also any crude pipeline inlets that are coming into the basin. So historically, there have been none of those. But in the future, and even right now, there's probably a little bit of crude flowing in on Plains' Wascana pipeline that feeds into their Plains Bakken North pipeline. They have made that line bidirectional, and we believe that is taking some Canadian volumes off the Enbridge mainline and actually bringing more supply into the Bakken, and it can get out on DAPL or some other options there. So that's a good example of a way that because of the constraints up in Canada, Enbridge is delivering some supply into Regina, and that's getting into that pipeline and getting down to the Bakken to get out of Canada. So that's kind of an interesting piece there. But to go and talk about our base production forecast under our base model, which was again the January model that we ran, we had base production increasing to over 1.7 million barrels a day by exit 2021. So that's production plus what's coming in on Wascana. You're almost at 1.75 million barrels a day of supply. And then that's balanced against your demand sources. So the demand sources are going to be in-basin refining. There are two refineries in the Bakken. One is either shut down today or being shut down in the near future to transfer over to a different feedstock. So you have the Mandan refinery left. And then you have your takeaway options, which are really pipelines and rail. So as you can see in the table, this should balance completely, and it does in the table. So you can see how or what egress options are taking the barrels away historically. What I want to point out here is, in this case, the DAPL expansion is what we've highlighted. That's one project where it's unclear how much MVC, how many barrels they have MVC'd on that. They did do somewhat of an open season, I believe it was a year ago, where they were able to capture some barrels above what the legacy DAPL pipeline could take. So there is some MVC protection on that DAPL expansion, but that's one where we would highlight and say it's not clear that they have a significant amount of MVCs, so in a downside case scenario, they would be exposed to lower volumes. And that's what the bottom table shows. If you look at our downside case, the production's down significantly. So we're only exiting 4Q 2021, we're only exiting at about 1.4 million barrels a day. Add Wascana on top of that, you're just above 1.4 million barrels a day. That's a decrease of 300,000 barrels a day of oil that has to be allocated across the demand sources. So in this case, due to some of the our beliefs on some of the MVC levels on some of these pipelines, how some of these pipelines are hooked into demand. So I would highlight Enbridge's North Dakota line. That's a common carrier pipeline. It isn't protected by MVCs, but what we have seen historically is they've been able to hold on to their volumes even when DAPL first started up, and some other pipelines lost some volumes to DAPL. They were able to hold on to theirs because they are hooked into, I believe some of the Minnesota refineries take a significant portion of what comes off Enbridge's North Dakota line. So we keep that largely stable. We do cut some of the other pipelines. Double H would be an example of one we cut, but it isn't a significant cut. So Double H has re-upped their MVCs for another 5 years. They did that in September timeframe last year. So it's our belief that they have quite a few MVCs on that pipeline, which protects the pipe. But what you can see is the downside case for the DAPL expansion, they do lose a lot of volumes there. So again, we don't have perfect information on what the MVCs look like, but our basins have to balance at the end of the day. So this would be a hit to the DAPL expansion. It's a great expansion, even with this level of flows. I know it goes to zero there in 4Q 2021. What you don't see is in the future it does grow more. It's a low-cost expansion. It's still a very good expansion. It's still very economical. But we do cut a lot of volumes away from that pipeline due to this downside case scenario. And this is the type of analysis we're running on every basin. So we're running this in the Permian, we're running this in the Eagle Ford, we're running this downside production scenario across all of our pipelines, across all the assets, and that's how we're getting to the downside that we'll show in later slides. Going to the next slide, and I'm sure Ryan can jump in if, as he wants, but this is the supply production forecast for, and we're using dry numbers here for U.S. Dry natural gas production. In the downside case scenario, we do assume that natural gas prices go down. It's an interesting point where people have brought up, hey, if WTI prices tank, you lose a lot of associated gas production. Could natural gas prices actually be stronger in an environment like that? The answer is absolutely yes. In this case, to show the downside, we cut the natural gas prices 20%, 10%, and 5% as well to show what that would look like. What's interesting in this is you lose 6 BCF a day of actual supply. That's quite a bit for the U.S. for demand that's pretty sticky in the U.S. Certainly weather impacts that, and certainly in a recession case scenario, you would likely lose some demand from ResCom in a scenario like that. You'd lose some demand from industrial facilities in a recession case scenario. Unsure if you'd lose LNG. Certainly that's probably at the margin at world LNG prices, what we're seeing. But if we run that price deck through our modeling, you do lose about 6 BCF a day of production. What's interesting is our Northeast numbers don't go down very much. So they do have seasonal declines, but we do have those ramping back up in later in the year as most Northeast producers ramp completions in the back half of the year to try to capture some of those higher winter prices. But we don't decline these that much for the same reason that we were very aggressive 2 to 3 years ago on Northeast growth. The story is the same. These guys are highly incentivized to fill their midstream commitments, and filling their midstream commitments requires them to keep roughly these levels of production. So certainly we can have a conversation around bankruptcies and potential reworking of midstream contracts, which is not factored into this analysis. We didn't assume bankruptcies. We didn't assume midstream contracts get cut. That's something that's certainly on the table in a low price environment like we put across, but that isn't factored into this analysis. And I would note these Northeast guys, it's very difficult for them to reduce their production because of those midstream commitments in a lot of cases. Ryan, anything to add to this slide?
No, I think I touch on it in a little bit later, but with those midstream commitments, we do see that Northeast producers generally have a higher percentage of their production hedged just because they have that incentive to fill those contracts. So that was really the main point I was going to add there. But essentially, with looking at natural gas, I think one of the key points that I took away from this analysis was you're more severely impacted on the oil side. You're going to see rig reductions in higher percentages for oil basins. So you are taking a lot of that associated gas off the market. And that's obviously been a huge concern for these Northeast producers that we've structured it as you have somewhat fixed demand in the U.S. and supply is really your variable. So if you take associated gas off the market, then that potentially provides some runway for these Northeast producers to backfill that. Again, one of the other concerns, though, that we've brought up is, I say demand is fixed. Are you going to start canceling more and more LNG export contracts? We've already seen one of those contracts been canceled in April. We see that more as a short-term phenomenon. We don't think in the long term you'll continue to see cancellations on LNG contracts. So we, based on this analysis, we think that the Northeast is somewhat of a safe haven, that those producers, just regarding bankruptcy, they are a little bit more protected in terms of like downside risk, in terms of volumes than an oil play would be.
And I'll take a question on the fly since I saw one show up in the chat, and we have oodles of time, it appears. So somebody asked, would DAPL still take rail volumes? Yes, to an extent, it absolutely would take rail volumes. The thing to think about there is there's about 180,000 to 200,000 barrels a day that we believe is just structural rail demand for the West Coast. that comes out of the Bakken. So certainly there's some regulatory hair on that number, and that may impact a little bit of those numbers. But the rail off of the Bakken going to the West Coast is one that we view as pretty structural. We do see the Brent to TI spread coming in, and that part of this analysis is certainly coming a lot if we saw production decline like in a downside case scenario. That you would lose some East Coast rail volumes from the Bakken under that scenario. But I would note that we think that 180,000 barrels a day is pretty much structural demand from the West Coast, to the West Coast from the Bakken, and that's what we hold those rail volumes at. So if you're a believer that that's not the case, certainly DAPL could steal more of those 180,000 barrels a day of volumes that we have roughly sticking on rail in the downside case scenario.
And another example of that too is Crestwood just signed up some long-term agreements on its coal facility out of the Bakken as well. So we are seeing that those contracts. I guess I should caveat long-term isn't as long-term as it used to be. I think they said maybe 2 or 3 year agreements. So, but we are seeing that there are significant contracts in place to take rail and that structural demand in the West.
So just highlighting a couple systems and the impact of the downside case to the volumes going through those systems, and it's pretty significant. So again, remember we're comparing this to our January models where crude was $60 backwardated to around 50 later in the curve, versus this scenario where we're at 35 and then we're in contango up to 50 later in the curve. So let's highlight Enable's Anadarko system there on the left-hand side, that top left-hand graph. So the line is our January model. The bars are our case and our downside model. And this is the case where, listen, East Daley's been pretty defensive for Enable's Anadarko system under $50 to $60 environment. And that's due to Continental being very active and having pretty good well results out there. Both in the stack, now shifting a lot of their activity to the SCOOP. So certainly that impacts IP rates on the gas side. They are lower in the SCOOP. But we did forecast, and as you can see there in our January forecast at that early January curve had that system growing, despite a lot of the rig attrition that you've seen in the Anadarko. Under a $35 to $45 scenario in 20 and 21, we lose a lot of rigs there. So Ryan covers that system, and he can go through the pieces on that. But were we at, Ryan, 21 rigs in the January one? I think we were at 21 assumed rigs on Enable system in the January model. I think that drops to
17.
Well, 17, and then even lower in the downside case. Yeah. I think we're at 5. We get down to 5 as the trough level.
Yeah, because you're cutting. I mean, back to that percentage chart that I showed you earlier, the Anadarko. Again, we're saying that it's the most sensitive to crude prices, so we're cutting that Enable's rig count by over 67% by the end of the year. So that you see significant rig attrition, and again on top of what they've already seen a reduction in drilling activity there already, and we think it's one of the basins that's most sensitive to crude prices because you drop through that threshold, and we do expect them to cut drilling activity quite a bit.
Yeah, so highlighting One Oak system, which is the graph on the top right-hand side, they are also impacted. I would say across the board, G&P is going to be impacted almost everywhere. In this case, we do have gas capture going up. So again, we're looking at volumes going through One Oak's plants. So this does account for higher gas capture because of the regulatory numbers that are required for them to capture around 91%. Even in that case, though, you still see a slight decline on their system for throughputs forecasted under this downside case scenario. So from late 20 to early 21, there is a little bit of downside there before you start growing back again and clawing back some of those losses. So there is a pretty big gap there, and I would note, and we'll get into this into a later slide, this impacts One Oak all the way through their value chain. So this impacts their G&P, and then it'll impact the amount of NGLs they collect. Some of those are MVC'd. I think most of the original Elk Creek expansion, I believe, is MVC'd. The expansion they recently announced, though, it appears, based on disclosures in the 10K, that a lot of that's under acreage dedication. So those volumes would be at risk, and those were volumes that we had filling up that pipeline under the January model which may be at risk now that in a downside case. Moving to the next slide, Ryan will hit on this hedge piece.
Yeah, and this is a section that we're going to focus on in the commodity snapshot. Again, that, like I said earlier, that will be published tomorrow. So I encourage you guys to go read that and download some additional thoughts on this topic. But one question we kind of floated around internally was, well, there is some protection here against downside prices, and you're absolutely right. There are producers with, some of them have significant hedge positions, and that is something that needs to be taken into account if we're going down to the asset level details that we're featuring in our midstream coverage. So we just did a quick survey of producers by basin in that table in the top right, which one of the conclusions there was the Northeast is a gas-focused basin that has a heavier percentage of volumes that are hedged for public producers that disclose their hedging activities. Which, that makes sense with the forward curve. You have a forward curve in contangos. Producers are able to lock in a higher price in the future. They're also protecting themselves against those. They have firm commitments on pipelines. So they do have those demand charges and overhead that they know they have to cover, which might be a little bit different than an oil producer, which is why we see a lesser percentage of crude volumes hedged in 2020 in crude basins. But the other key thing I want to point out here is as you go to 2021 and 2022, we see very little mentioned about crude hedging in these for operators that operate in oil basins. So that is a risk, again, that we see a lot of our production declines are not in 2020. They're delayed to 2021 and 2022, and that's when you have a lot of your hedging activity rolling off in 2021 and 2022. And that's, if you think back to the shape of the forward curve, we've been in significant backwardation. So if you're a producer looking at the forward curve, why would you lock in, a significantly lower price on the forward curve than, if you expect spot prices to continue to exceed the forward curve expectation? So wanted to include that summary of hey, these are some things to factor into some of those asset level conclusions that we're making. And one of the easier ones is, Antero has a significant hedge position in the Northeast. They're protected in 2020 and 2021. So for a system like MPLX and their Sherwood plant, they have protection against volume downside. They also have MVCs at that plant. Again, we didn't factor in any bankruptcy assumptions of these E&Ps, but some of them do have significant price protection in a downside case like we're running in these scenarios. The last point I want to touch on is if we look at other counterparties on at least like gathering and processing systems, one thing we wanted to point out is if you look at like the large integrated producers that have they have a strategy around developing some of these assets like in the Permian Basin, we developed this chart to really just show where do these larger, kind of more steady counterparties, where do they send their volumes for gas processing? So if you go across the list, you can see Enterprise has about 48% of its throughput in the Permian Basin as gas plants are supported by these larger operators like BP, Chevron, Exxon, and Oxy. So again, in my mind, that's a good thing. If you have a big counterparty like this, they're probably going to weather some of the cyclicalness in the oil and gas business versus if you have a mom and pop that's drilling a well and they just decide to stop drilling one day, you're going to see more volatile throughput in your system if you're not protected by MVCs. So again, that's one of the positives of diving into this detail is you can flush out who has like the superior counterparties. Are they hedged? Are they large producers that are dedicated to an area that might have a natural hedge in their portfolio?
All right. Next slide, we'll get into the output of the analysis that we ran. Really, as I explained at the beginning of the call, and then through the rest of it, it's how we run those volumes and take down rates where we think rates need to come down and where there's POP, POL exposure. So we're running all of that through our models. What's not included here, I want to reiterate, bankruptcy assumptions are not included here. Reworking of contracts due to E&P distress is not included here. Certainly that's a piece to think about and to talk about, and it's a piece that East Daley has quite a bit of data on. So we use index of customer data to model out all our long-haul natural gas pipelines. So we know at a very granular level what the counterparty risk is to most of the pipelines that we model on the natural gas side. Also, we have our allocation model, which allocates G&P wells to actual midstream systems. So on that side of the equation, we have an estimate of who the counterparties are behind G&P systems as well. So we are monitoring that counterparty risk and kind of internally looking out for that and seeing where there may be risk to some of these systems. But the output here is I've separated out the impact, and I'll reiterate one more time, this is the impact of looking at our January models versus the model in the downside case. So this is the negative numbers you see is how much adjusted EBITDA, we're using that as our proxy for cash flow, but how much adjusted EBITDA is impacted by that red curve, the downside case, versus the black curve, our January case. So when you see the negative numbers here, it doesn't necessarily mean EBITDA is going down for the company in those years. It's the relative impact to our January models. So some of these may not be a surprise, and some of them may be. They certainly were to me, and we're very much into these assets and know these assets very well, but when we run and do the full analysis, some of these were certainly a surprise to me. So not a surprise. TC Pipelines, to me, was not a surprise. They're almost all demand-based on their natural gas pipelines. It's 100% natural gas pipelines, largely demand pull. To the extent that there aren't demand pull, it's push contracts from the Bakken and Canada into full pipes. So we don't see any significant downside or material downside from the downturn for TC Pipeline's business. Where I would bucket some interesting ones here is the Northeast guys. I mentioned earlier, East Daley's analysis doesn't forecast or see significant declines in Northeast volumes. So these guys, as you can see on the right-hand side, their year-to-date equity returns have been hammered, and potentially for good reason, with some of the counterparty risk that gets elevated because of these lower prices. So certainly companies like CNXM, AM, and EQM are ones that have high leverage to E&Ps and could have counterparty risk of deals being redone or bankruptcy counterparty risk. So but I would say on the adjusted EBITDA side, we don't have adjusted EBITDA going down significantly because volumes don't go down significantly in our modeling for the reasons we went over earlier. Other names that are potentially interesting, I don't think it's a huge surprise that Enbridge doesn't have a lot of downside, that most of their supply is coming from Canada, who's constrained. So even in an environment where you see a declining production profile from Canada, and it wouldn't be very much compared to the U.S. because of the oil sands projects, any declines are probably taken from rail first, so their pipelines would stay largely full in our analysis. And then they have natural gas pipelines as well, and for the reasons I mentioned earlier, on TCP, they're going to be well protected. Kinder, well protected. Certainly their CO2 business has some exposure, but I would note that they're well hedged in their CO2 business. So the majority of the downside, that 20% dip that they would be impacted on in 2020, I think they're about 90% hedged on their volumes for 2020. So they fare pretty well. An interesting point on Kinder, we did add some upside to the terminal segment. So they likely would see some storage upside for storage rates as we go into a deep contango curve for oil and probably most products. They could see rate escalations on some of their storage assets. So we did factor that in. That's counterbalanced on the terminal side with some lower throughputs through some of their bulk terminals and probably some of their liquids terminals as well. Other areas to think about with Kinder products pipelines, we do risk the volumes a little bit there, not a ton though, so those are pretty stable even in a recessionary case. Few other names on here. Plains is one that I think is somewhat interesting. They are significantly protected via MVC agreements for a lot of their assets. The other piece of the equation is East Daley has already risked a lot of the rates on their legacy assets in our January models. This doesn't change our forecast that the Permian's overbuilt. We believe that in January, even under a $60 environment. It's certainly more true under a downside case environment. But the downside to the rates is probably not huge compared to what we already had factored in there in our January models because you were so overbuilt already. I think that's a good summation of the tier one guys, the guys that aren't significantly impacted. Again, with the caveat, there's counterparty risk here to think about and to take into account. Ryan, anything on the tier one that popped out at you?
No, again, one thing from my assessment of counterparty risk of the Permian Basin is some is 100% supported by Exxon. So a good counterparty to have there with limited fluctuations with SMLP showing up in Tier 1.
Tier 2, so some moderate impacts here. Again, we're talking about an 8 to 12% average cut in adjusted EBITDA versus our January modeling. So gel's an interesting one if you look at the year-to-date equity return. And this 8% does include the softness that they've reported in their soda ash business that really was, it seems like was unrelated to the virus. We have included that in there. So that's something that kind of came together toward the end of 19. That is included in that 8% number. And Ryan could probably talk a little bit more about some of their assets. A lot of it's offshore. So again, I mentioned earlier that offshore is probably not going to be significantly impacted by the lower prices. But Ryan, any thoughts behind gel?
Yeah, they're lined up to get growth in 2021 and 2022 with several significant offshore projects. Again, like Matt mentioned, those are long lead projects that are dedicated to a lot of prior CapEx spend to bring those online. So producers generally move forward with those offshore projects, and they're contracted. They're slated to bring online additional volumes. You know, some of their offshore transmission lines are running at about 50% utilization. So they have the room to bring on those projects. Without additional CapEx spend, they just tie those into their system under contractual agreements. So we're pretty positive on gel's offshore business, but there is potentially some additional risk so that they're onshore, just with oil throughput. They rely on rail coming from Canada. So if you had a dip and you were just able to use, like Matt said, Enbridge's pipes of moving Canadian pipeline or Canadian crude through pipelines in the U.S., you wouldn't need to rail it down there anymore. So, but yeah, the soda ash business is where they took a significant hit based on weaker guidance than the street had coming in 2020.
Highlighting some of the NGL names, Enterprise and ET, obviously some exposure there to volumes through their value chain, through the Permian and other basins that they're tied to. Again, ET in the Northeast, largely we don't have volumes going down that much in the Northeast, but I would say their downside, that does create downside for them, those lower volumes through their Permian assets, and then that lower NGL volumes through their through their pipes and fracs and export facilities. That is somewhat mitigated by a lot of the MVCs that they have on a lot of their pipelines. So some of those crude oil pipelines have MVCs that protect them. ET has a decent natural gas business, the pipeline business that's not going to be significantly impacted by this. So that mitigates that. An interesting one is EnLink. Listen, they've been hammered. Their system's lost a lot of rigs over the last 18 months. They're probably not lower on this list because they've already lost a lot of their rigs. So when you only have a handful of rigs left on their Anadarko system, we can certainly cut out more, but it just doesn't impact their system as much as, say, an Enable system gets impacted. So Enable's rigs have held up much better comparatively than EnLink's. At a $35 scenario, Enable gets thrown into the same bucket as EnLink for as far as the amount of rigs are on their system, or roughly the amount of rigs and the rig attrition that's on their system. So EnLink's a case where they do have some assets that'll fare pretty well, but the downside is largely Permian at that point. Certainly a little bit of Anadarko downside, but a lot of the damage on the Anadarko had already been done by the time we did our January models.
I was going to jump in and say with EPD and ET, before Matt gets to NuStar, some of their bigger CapEx projects are on the fractionation side coming up as well, and we believe those are mostly committed to, but they again, looking at the contract structure, a lot of those are under MVCs as well. So not factoring in any bankruptcy risk here, we do believe that those are still good projects. So if those weren't committed to by MVCs, that would be a big issue because you have a huge CapEx spend and you don't have the volumes to support it. So that could put them in a bad spot. But the good news is that especially with ET doing that multi-basin deal with a large integrated producer, they supported those volumes. Their growth CapEx projects they have volumes supported behind them. So that's where they have committed volumes. So we don't view those as really risky at this point.
Yeah, I see a couple questions asking for slides. Certainly, we'll share those with everybody who wants to reach out after the call. And a lot of this stuff's in the snapshot that we wrote on Monday too. Happy to share to all that. Just reach out just reach out to East Daley and we'll get those to you. Left in Tier 2, Ryan knows that I'm going to talk about NewStar, so might as well talk about NewStar. Listen, they have a significant amount of volume exposure on their Permian system. So their Permian gathering system still grows for most quarters, even in our downside forecast. But it is a haircut to the growth rate, a pretty significant haircut to the growth rate. They do have some MVCs on their Corpus Christi export facility. I don't know the level of those MVCs. I don't believe they've disclosed those. It's East Daley's belief that they are running above those MVC levels through the facility, through a lot of volumes from Trafigura. We do cut those a little bit due to less volumes flowing into Corpus Christi just because of less production. As we balance the pipes, there will be less volumes flowing into Corpus Christi. I would note that they actually see some upside from the lower case scenario. They do have a pretty sizable storage business, and certainly some of their facilities, I'm thinking Linden, they have a large facility in the Northeast. Their St. James facility would likely see rate upside in a deep contango environment that downside case would bring. So I don't know the term and tenure of the contracts. I don't believe those are public on their storage facilities, but depending on those, there could be anywhere from a little bit of upside on the storage, so potentially a lot of upside on the storage. Remember, these storage assets have had rates come down a lot since the last time we were in contango. It seems like we've been in backwardation or a flat curve forever. So that will help mitigate, and I do put in some slight upside to some of their storage facilities in our downside case scenario. Other names to mention, Wes, listen, they're tied to largely a large integrated counterparty, but they're not immune to downside as well. In a $35 scenario, we would expect a guy even like Oxy to slow down in that scenario, and I think Oxy said as much. If prices go down, they can adjust their CapEx and their production forecast. So a decent amount of downside for Wes in this analysis as well. The Tier 3 is the largest impact, and I would say this is largely the guys who still have a moderate or a large amount of rigs on their system in what we would consider Tier 2 basins. So the Anadarko certainly enables a name that we've gone over on that. In a $35 scenario, you just lose a lot of rigs off of that system, and there's significant volumetric impacts. Some of the other guys in here, Enable included, DCP included, they have some percent of proceeds, percent of liquids contracts, which are obviously impacted, especially if you're not hedged. Depending on your level of hedges on the NGL, gas, or oil side, if you're getting a percent of if you're getting some equity barrels off of your G&P business, that's going to impact the downside for those guys. Crestwood's an interesting one. That one's very impacted. There's certainly some downside to their Jackalope system in the Powder River, but a lot of the impact, and Ryan might talk about this, is on their Arrow system in the Bakken. So they collect 3 streams there, right, Ryan? So yeah. It's a lot of leverage. It's not like they're just collecting natural gas there. They're doing oil, gas, and water, right?
Yeah, so every well that comes onto their system, obviously, they get 3 revenue streams off of that. So they are heavily focused onto that one. So when we cut drilling activity on that one system, we're hitting all 3 revenue streams by that, by that similar percentage of reducing drilling activity. So that's where, similar to One Oak, where you're kind of levered to one area, like one concentrated area. They get impacted there, as well as the Powder River. Like the Powder River is one of the top, it's one of the most sensitive areas to crude price changes according to our models. So we also reduced, Crestwood's forecast for their Powder River system, which has to be behind that one.
Yeah, some interesting ones. One Oak shows up in Tier 3. That may be surprising to some people, and really, again, we're not 100% sure what the MVC levels are on things like Elk Creek or their G&P assets. So we do assume a fair amount of volume exposure to those assets. So where we had just a ton of growth, as we showed in one of the previous slides, for what they could capture for gas, and then what the NGLs go down all the way through their value chain, all the way to their frac facilities in Bellevue, they would lose a lot of those volumes under our analysis. Again, this is with the caveat that we aren't exactly sure what the contract MVC structure looks like on that. If it's more MVC than our assumptions, then this downside could be too high. But I would note that ONEOK is it really, none of these guys are completely immune. TCP, obviously we show they are immune, but most of these guys with G&P assets, they're going to see some level of downside from this. ONEOK having that huge value chain from the Bakken, if you reduce production in the Bakken, you produce throughput through the systems in the Bakken, they are going to be impacted. There's just no way around it unless they're fully MVC'd. Hitting on some other names, Altus is on here. So we previously had 0 rigs on Altus' system until late 20. And then with this downside analysis, I believe we clear all rigs from their system until 2022. Don't quote me on that, but I think that's the time frame when we bring back a rig, I believe, on Altus' system. So the impact there is on the G&P side for their Alpine High G&P. They're also impacted from Chinook volumes being reduced in a downside case scenario, less production in the Permian, less Chinook volumes, as well as Epic Crude having some lower volumes as well. So they have JVs on Chinook and Epic Crude. So that sums up the impact to the midstream. Again, I'm going to reiterate one more time, this is under the downside case scenario, so pretty much a worldwide recession price scenario, and this is relative to our January models. So this should be a good data point to show you who's most impacted by shifts in prices according to East Daley's asset level modeling. Anything to add, Ryan, before there's some questions here that I wrote down?
No, I think that was a really good run through, Matt. And again, like, I think we enjoy running these scenarios, and it's exciting to see the changes in the models running these scenarios through. But again, doing everything at the asset level enables us to go down to these details, and we're happy to schedule calls on these assumptions. We posted the models on our client portal where you can go through and see the impacts of the downside scenario model versus the old model. And if any clients have questions, like, we'll just hop on the phone and walk through the assumptions we plug through there. Again, with all the uncertainty out there's a lot of other scenarios and outcomes that they could run through here. Again, we didn't take into account bankruptcy risk, so there is another layer of additional detail that we could certainly talk through, and our analysts that cover these companies can certainly go into more detail on each one of these and explain the additional risks that we didn't capture.
Yeah, I should note, in case we didn't make it clear, all the downside case scenarios in our models are available on our client portal now. So if you're a client, you can certainly go download those. Those are available. Some of the questions that we've had on this and we had come in during the chat, somebody asked us, how are we forecasting rig sensitivity for each of the individual basins? So Ryan touched on that a little bit during one of the slides. But what we do is we run a linear regression that's tied to price. It's certainly not a perfect way to run that analysis, but over time the R-squareds are decent to run on that one. So that's the methodology we're running across most of those basins. Somebody asked thoughts on Northeast counterparty risk for long-haul natural gas pipelines. That's an interesting question. So the assumption, or my answer to that question, depends on like the outcome of Mountain Valley or Atlantic Coast Pipeline. So if those two are built over the next, let's call it, year to 2 years, you probably are very overpiped out of the Northeast, and counterparty downside to a bankruptcy scenario on some of those legacy egress pipelines is probably pretty high. So your spreads would be collapsed if both of those Mountain Valley and Atlantic Coast Pipeline were to be built. Your spreads would come in significantly, and you're likely going to get hit decently hard on some of those egress pipelines. If they aren't built, I show we're pretty close to being full for Northeast egress. Obviously, that fluctuates during the year. In the winter, you burn up a lot more gas in the Northeast. But in the springtime, we're pretty full. Spring, fall, even summer, we're pretty full on egress. So Mountain Valley and the ACP not being built, it's not a huge. I mean, certainly there's probably some rate downside into bankruptcy for some of these long-haul pipelines, but it's not as severe as if Mountain Valley and ACP are online when that happens. Thoughts on the G&P systems where gas volumes are not as sensitive to lower prices. I think we hit on that in some of the slides. What was interesting to me is remember that systems that don't have a lot of activity today are actually probably not going to be that impacted. So some of these guys have assets in the Barnett, some of these guys have assets in the Fayetteville. Those aren't going to be impacted. We already have those pretty much in just basic regular declines with no activity on them. So the Western Rockies, when we ran some of our January forecasts for Enterprise, MPLX has some systems out there. Williams has some systems out there. A lot of the rig attrition was already built into those January models that we've already seen. So the downside, because of the price scenario coming down, was pretty minimal on those systems.
I think the other thing to think about is the GMP systems that are impacted by the lower prices is the ones that have direct price exposure as well. So going into that contract analysis, is it, the question is it a fee-based system with MVCs, or is it a direct commodity exposed system with percent of proceeds contracts and acreage dedications? And that's where you do get a contrast of different structures on these gathering and processing systems, and the companies that have more direct commodity exposure are hit both on the lower price because they're getting a lower price for their equity barrels, and they're also impacted by reduced drilling activity in those basins. So I think one of the companies with the highest direct price exposure that we model is DCP, and I think they're only 30% hedged going into 2020. So without significant hedges in place, they are significantly exposed to crude prices. And in our downside scenario, I think we trimmed their adjusted EBITDA by over $120 million just due to direct price exposure. And then we started cutting rigs in those basins, and we had lower throughput. The good news is they have some minimum volume commitments, like on their DJ system, but overall, they're largely exposed to volume declines and direct price exposure. So that's a company that is a little bit more impacted because you're hitting it both on the rate that it's getting from producers, effective rate you could call it, and the volumes that are going through its assets.
What are some another question? What are some of the assumptions around refined product pipeline volumes in the downside case scenario? So if you look back at the EIA numbers of products supplied during like 08, 09, based on a 2007 base level, 08 declined about 5%, and then another 5% from 08 to 09. So around 10% overall during that Great Recession. We did less cuts on this case scenario. So we assumed 2020 starting in 2Q. We took down volumes from our previous forecast 5%, really using a base level of 2019. In 2021, we backed that off to where it's 3%. Again, that's based off of 19, so you're actually increasing volumes about 2% from 20 to 21, and then just a 1% cut in 2022. So didn't take those down a lot. Certainly, depending on how bad things could get, you could argue you need to take more volume off some of those refined products pipelines. But pretty stable business overall is what I would say on that. Last one, and I kind of touched on this in some of the slides, is storage upside. So storage upside in the downside scenario, how much do we model in? It's a bit of a swag. It's asset by asset, depending on what I know about the asset, and frankly, the term and tenure, as I mentioned earlier, of some of these contracts, most of these contracts isn't public. So I'm not sure when actual contracts fall off, but what I would say is we pretty much modeled in slight upside. I would say where we might have cut some rates because of the continued backwardated curve on some of the assets, we probably bumped them a little bit, maybe 10% on some of the rates, maybe 20%. Depending on when contracts roll, you could have a lot more upside to the storage than what we factored into this analysis. And I think that's all the questions. Ryan, any last thoughts?
I think there was another one about, I kind of touched on this a little bit with DCP, comparing DCP to Energy Transfer and EPD. I think one of the takeaways there is that DCP, they're similar to ET and EPD, they're protected on their downstream assets, so like their NGL pipes and DCP, logistics and marketing segment. Those are fairly protected. We have minimum volume commitments. DCP scores all the volumes. So the caveat, though, is DCP is much more price exposed than like Energy Transfer and EPD. So the price exposure for DCP is like 8 to 10% of their EBITDA comes from direct price exposure, whereas like Energy Transfer, Enterprise are like 2 or 3% of their earnings are direct price exposure. So that's where DCP actually, that's why it's a tier 3 versus a tier 2. and I would say their diversity, just they're not as diverse as like Energy Transfer or EPD, so they're just more impacted by the basins that we cut drilling activity, like in the Eagle Ford, the Anadarko Basin, and even like the DJ and the Permian to a certain extent for DCP.
And one of the questions is, will there need to be cuts on the distributions and the 20% yielders? Listen, East Daley's not going to make a call on if people need to cut. I will quote some of our coverage ratios that I can remember off the top of my head. Actually, don't quote me because I don't. I'll tell you what I think of off the top of my head, but I believe Enable bottoms right around 1.05 for a coverage ratio. Now, that doesn't mean they necessarily won't cut or will cut or won't cut. There's a lot of factors to take into account when a company makes that decision. But we do, in our downside case scenario, I believe throughout the forecast period through 24, Enable does cover their distribution. DCP, I believe, falls under 1. Again, don't quote me on that, but
yeah,
I do believe they fall under 1. Again, that doesn't mean they're going to have to cut or not.
One of the factors of DCP, it's a good point, is they still have an option to buy into the Sweeney fractionators at the end of this year, and I don't believe they've executed that. They have a 33% ownership in that. It's a big CapEx spend, so that gives them some flexibility to not have to execute that growth project. So that's good for them that they have an option there that they don't have to execute on. But we still fall below a 1 times coverage for them, I think, in 2021 and 2022. Yeah,
and going back to Enable's coverage does increase significantly in our downside model once Gulf Run comes online. So that does help them along with prices recovering in the modeling in 23 and 24, and a little bit in 22, I believe. So I think Enable comes up a little bit in 22. Maybe it's 23, but they do come back up on a coverage ratio. Wes, I'm less certain. I believe they can cover the distribution, if I remember correctly, but if you're a client, certainly you can download the downside model and see that. I just don't remember off the top of my head whether Wes covers or not under our downside analysis.
They have some minimum volume commitments. So they got those sweetheart deals from Anadarko. So they do have some MVCs, and even like their Latham 2 plant for Western Gas, they contracted that out, take or pay to DCP. So now DCP is on the hook for making that payment to Wes. So from Wes's perspective, that actually turns out to be a pretty good deal for them now. And again, not good for DCP in that situation.
We're running up on time, so it looks like we've ran through all the questions.
A couple house cleaning items. I'll say the recording will be available on our website as well as the snapshot reports for you to download. So please go to our website, download those. If you don't have a login to our website, please reach out to us. If you'd like a copy of the presentation, you can email us at sales@eastdaily.com. Again, that's sales@eastdaily.com. And yeah, please feel free to reach out and schedule times with our analysts to talk through the details. Again, our analysts that cover each one of these companies can go into much greater detail on risks and upsides down to the asset level beyond and above and beyond what Matt and I have done today.
Yep. All right. Thanks a lot for joining us. Enjoy the rest of your day. Thanks.